Hi, this is Your Money Matters on NDTV Profit, where we discuss everything that is related to your personal finances. And often we talk about mutual funds. And today I'd like to spend some time talking to an individual who will give you some perspective on how the largest mutual fund in the industry is managing its money. In fact, your money, I should say, rather the assets that you have given to them to invest. I'm joined at the start by Ruchit Mehta, who's the head of research at SBI Mutual Fund. Ruchit, thanks so much for taking the time. And the reason why I wanted to speak to you is because I want my investors to understand how you and your team and the fund managers that you help to make the decisions to invest or not to invest are planning their strategy. So let me start at the onset by asking about what I think a lot of people are wondering, which is, has a recent bottom, in your opinion, been found, and the kind of frenetic selling that you saw over the past weeks and months, will that likely abate, or has that abated?
Thanks for having me on the show. So I think if you see what has happened over the last few weeks, particularly the way the markets have behaved in all through February and March, is going to be a very volatile year per se, right? You will have these intermittent bounce of markets bouncing up and then going back through a bit of a corrective phase that's there. And the reason is that you will have now a fairly high degree of uncertainty as to how the global economy is going to behave. A lot of uncertainty on economic policy, given that you effectively have tariff wars being initiated, a lot of question marks on whether there will be tariffs or there won't be tariffs. If so, on which good, which product, etc. And uncertainty will lead to investors being fairly cautious. It will lead to even corporations being cautious, and decision making will kind of get deferred. So I would say that the volatility that you've seen is something to sort of expect for the next, at least for next 2 to 3 quarters. It will be challenging to say whether we've seen some form of abatement of the selling pressures. It would be difficult to call out a pure bottom per se. Though at the margin, having seen the correction, I think equities look a lot better than they were about, say, 3 or 6 months back. The large cap universe looks a lot more better, given that the Nifty has broadly corrected about 15% from the top that's there. So, yes, at the margin, equities are looking slightly better. And within that, the large cap universe looks a lot more better that's there.
Okay, great. So before we delve a little deeper into some of the schemes that I would like to speak about, I was reading your fact sheet from the month of February and the comments that are in the preface. And a couple of the factors that you're talking about, of course, is the uncertainty and so many aspects with regard to even the US growth and inflation dynamics. But you've alluded to the dollar index and yields on treasuries coming off a little bit. And the dollar index move rhyming with what happened in 2016. Why is that significant?
I think, we saw this kind of play out in 2016 as well, where when the current administration led by Mr. Trump, when it came in power in 2016, in the post-election scenario and heading into the sort of swearing-in ceremony, etc., they had talked a lot about dollar strength. And we had seen that in anticipation of some economic policies, the dollar had rallied quite a bit. And it was kind of similar, the commentary this time as well, right? So post the November US elections, there was a lot of chatter that perhaps you will have a refocus back on dollar strength per se. And in both instances, you had the US economy, which was humming pretty well. So I think a combination of those things sort of makes us see that, the behavior of the DXY is pretty similar to what happened last time around as well. And the recent correction that you've seen in the DXY is also very similar to the correction that you saw last time as well. So I think we are seeing some bit of history repeat itself at this point.
What are the implications for Indian assets then? If the dollar does come off as it did and there's no reason to expect it not to. A lot of commentators are expecting it to come off further. Then what does that mean for Indian assets?
So if you go back in history, right, a weak dollar tends to be positive for emerging markets, and fall in treasury yields in the US is also positive for equity assets in general, because obviously it makes money a lot cheaper, the cost of equity goes down. Now, if you have a combination of falling bond yields and therefore falling cost of equity, and you have the dollar weakening itself, logically one can make the call that emerging market look a lot more attractive. Now, within the emerging market basket that's there, right, there are fairly limited potential markets that one would look at where you see long-term growth potential, healthy return on equities, under-leveraged balance sheets, a sizable market, etc. And India fits in very nicely in that basket. And therefore, it's not unreasonable to anticipate that if the dollar continues to weaken, if US Treasury yields continue to weaken, then from this point in time, emerging markets, and particularly India, could see a reversal of the outflows that we've seen. And you could see the FI community pouring back some of the money that has been withdrawn in recent months. That's there.
Okay. Now, we are speaking at a time, Ruchit, when there is a spurt of buying, there is a recovery that is taking place underway, not just for the large caps. We're seeing a lot of beaten down pockets in the market that are finding favor once again, even in the broader end. My question to you is, first, let's talk about the hybrid strategy that you have, because really that is often a barometer of how you as a fund house are looking at opportunities in risk assets. So have you moved more towards risk assets over the course of February, and even now we're in the 20th of the month? So how does that stand right now?
Yeah. So if you remember last time we spoke about an asset allocation framework that we have, which kind of gives us a objective, quantitative framework of determining, whether you want to be overweight or underweight on equities. And till about early part of this year, around Jan, Feb onwards, we have been on the lower end of the equity allocation, right? In the equity allocation, the indicated equity allocation was about 20%. In a strategy that should be, say, 50-50 for being neutral between debt and equity. So we were quite underweight on the equity side of it. And the recent correction in the markets, the fall in the bond yields, and the adjustment that's happened on the earnings side has resulted in the allocation model inching up its equity allocation. So we are now with an equity allocation close to 60%. And therefore, a lot of our hybrid strategies which use this framework as a mechanism to sort of allocate equity have seen an increased allocation to equities process. So the balanced advantage fund of ours, which was in the 25-30% equity, long equity allocation, has now seen its equity allocation go back to close to 50-odd%. And we anticipate that if markets remain subdued, then the equity allocation could get ramped up even further from here.
Oh, and to what extent could it get ramped up, Ruchit? And what would that indicate based on the model? If it's currently 50%, and that is that normal? So 50%, just to understand it, 50% would
be... It's at 60%.
Oh, it's at 60%. Okay.
Yeah, so it says to be overweight on equities, and within that it says to be overweight on the large cap side of it. For it to rise further from here, it would need a lot of other factors to move for, particularly two things. Right? You need valuations to be a lot more attractive. Now, that could come primarily through either you see further price correction, and therefore valuations become a lot more attractive. But more materially so, you would need to see a recovery in earnings estimates. So far for fiscal year 25, we've seen that earnings estimates have been cut quite sharply. I think beginning of the year, we were anticipating close to 17-18% earnings growth. It's down to about, say, 4-5% for this year. And if we see that there is improvement in earnings prospects for, say, fiscal 26, then the equity market attractiveness goes up. So I think you need both. You need maybe a bit more correction on valuations and a recovery on earnings. for it to kind of inch the equity allocation higher. Sentiment has been bad. I think we've seen a tapering off of a lot of market sentiment. Uh, Retail activity has plummeted. IPOs have got deferred out. So that's pretty good from a sentiment standpoint. But yeah, you need some of these factors to get a little bit more favorable for the allocation to be pushed even higher.
Your own research, does it point to that second leg though, the earnings picture? There are a lot of pessimistic views in Ruchit. I think that's a sign of the times, because when markets are not doing particularly well, that the tendency is to think that everything is gloom and doom. But is it really that bad? Would you say that things will improve maybe in the first quarter when certain factors, including the government's own measure to boost consumption, comes into play?
So there are two aspects to this, right? I think, we see the domestic part of the economy doing fine, right? Yes, the tax cuts are going to be helpful. They kick in from 1st of April onward. So, everyone who's salaried will see a bit of an earnings improvement that's there. The jury is out what the, taxpayer is going to do. Do they save and reinvest, or do they kind of make purchases, say electronic products, or pay down for a bit of a small holiday and stuff. So we don't really know what may actually play out, but yeah, there is a boost to consumption that's likely to happen going forward. We are seeing early signs of recovery on the rural economy front as well. Certain segments continue to do well. For example, travel tourism, you all would have seen it, right? First quarter airfares have skyrocketed, right? I mean, everybody was traveling to Uttar Pradesh during Jan Feb, right? Fares are gone like north of 40, 50K. Hotels were going full. So I think the domestic economy seems to be fine. I think the question really happens more so on the global side, given the degree of uncertainty that's there. So certain sectors, for example, IT, could face a bit of a question mark on their growth aspect, because if the US slows down, typically that does mean that IT growth will also slow down. And IT had a fairly bit of a good year last time. The joker in the pack is going to be what happens to commodities. So, you have two moves in energy prices are a bit lower, but other commodities have inched higher. So we'll have to see how the commodity pack delivers on the earnings side. But broadly, there are limited downside risk at this point in time, because the large contributors to the market earnings, right? Like, for example, financials, they roughly contribute 35% of earnings for the market, right? That's completely domestic, fairly resilient, and in fact, at the margin, you've seen a lot of positive news flow come through. The RBI has worked to ease financial conditions. Liquidity has been eased off. Certain changes in the regulations have been deferred or pushed back for at least a year for now. So, at the margin, the financial services sector looks a lot more attractive. It's underperformed the last 3 years. Earnings growth seems to be fairly fine. And if the economy is in a bit of a rebound, given the early signs that are there, then banking credit should pick up. So there are some risk, particularly on global facing names. But by and large, we think somewhere between the 12 to 14% mark for the earnings growth for the Nifty set of companies should be okay for this year.
Okay, interesting. FY26, you're saying?
Yes.
Okay. Ruchit, in your FlexiCap fund, and I only have data for February, the allocation is 57.4% large cap, 14 odd percent mid cap, 14 odd percent small cap, 6% foreign stock, 8% odd cash. Is the cash intentional, or is it only incidentally, only because you had certain collections which you haven't yet? I mean, I'm guessing the fund manager would be better placed, but I'm trying to understand deployment and strategy, opportunities to deploy in the broader markets.
Yeah, so we have been fairly conservative on the market, right? I mean, our construct has been to be more conservative over the last 6 to 8 months. We have been negative because given the high valuation that have been, so we have been sort of trimming out our exposures to certain segments of the market, particularly on the middle, the small cap side of it, and looking to sort of redeploy as and when prices are a lot more favorable. So some of the cash that you see is a combination of increased inflows plus the portfolio churn that's happening at this point.
Okay. Going forward, does that... so a lot of people have talked about, a lot of your peers have talked about finding value in large caps, and therefore in the schemes that are more broad-based that would allow you to have that canvas. Would you move even further towards large cap? And does that structure change?
So, we've been positive on the large cap space for quite some time, right? I mean, again, going back to our last conversation, we did call out that large caps are a lot better than mid cap. Mid caps are better than the small cap side of it, and that view hasn't really changed. And across most of our funds, we would have maybe a decent odd allocation to the large cap space as well. But for us, I think we've been avoiding a lot of thematic plays or a lot of momentum plays in the mid and the small cap side of it. We've stuck to the ideas that we find attractive from 5-10 year perspective. So they are more durable business models. So therefore, the current correction or changes in the market environment do not warrant us to sort of necessarily exit some of these names. In fact, given that some of they have corrected, and become a little bit more attractive than when they were 6-8 months back, we would probably be adding to some of those names. So, yes, if you are looking at fresh allocation to money, then the large cap space is where you should be allocating money more to. Within portfolios, there isn't a very significant shift at this point in time, given our positioning already was a lot more conservative.
Okay. So 12 to 13% earnings growth, and this is the last point that I want to raise with you. And this is often something that I ask individuals like yourself, representatives of the mutual fund industry and your own firm, to help my viewer and your investor understand what to expect in the near to medium term. How should you benchmark your expectations, Ruchit?
See, I think, versus about say 6-8 months back, right, when the expectation was that equity markets would probably give you very mediocre returns, subpar returns, probably closer to low single digits. Obviously, a 15-16% correction in the broader market means that your expectations should be a bit better. So, at this point in time, I think if you get close to high single digit or low double digit returns, right, close to the 10, say between the 9 to 12% mark, you should be sort of happy with those kind of returns that's there. You still need some more bit of correction to happen in the market, right? There are still a lot of companies, if you compare to what their valuations were pre-COVID to versus where they are still a lot higher, right? Companies or sectors that would get, say, 20 times multiple are still getting 35, 40, 45 times multiple. There is still a lot of momentum in or froth in many smaller cap names. So yes, at the margin, your return expectation should be better given the price correction that's there. And if I were to say that, if we take, let's say, 14% earnings CAGR over the coming 3 years, and some bit of valuation correction, then yeah, sure, you should anticipate close to 10-11% equity returns comfortably. But yeah, you do run the risk that this year, you could see a lot more volatility, maybe a little bit more correction. And frankly, you should be happy if there is a nice bit of correction happening. And so, then you really can get back into equity markets a lot more aggressively, have a higher allocation to equities, and get better returns going forward.
Yeah, you said it. Thanks so much, Ruchit, for joining in. Pleasure speaking with you as always.
Thank you.